Oh, on the agenda tonight, Donald Trump found guilty of, what was it again? Oh yeah, banging a porn star while being married and running for president and then trying to hide it. Oh my God.
He's a punk, he's a dog, he's a pig, he's a con, a bullshit artist, a mutt who doesn't know what he's talking about, doesn't do his homework, doesn't care.
New York Fed President Williams said inflation is under control and we are on the path for a soft landing.
He's a punk, he's a dog, he's a pig, he's a con, a bullshit artist, a mutt who doesn't know what he's talking about, doesn't do his homework, doesn't care.
As DELL and Salesforce stocks crash this week, is this the beginning of the pop in the AI bubble?
No!
Whoa! Hey, don't I got a say in this?
As the US consumer gets weaker, here's how you get rich from others getting broke. And did the plunge protection team intervene in the stock market before the close this Friday?
Plunger boobies!
All right. Today is Sunday, June 2nd. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. Hope everybody had a great weekend, but folks, we gotta go back to business now. You see, in the last public video, everybody said, hey, Maverick, this is going to be a nothing burger kind of week. It's the shortened holiday week, low volume, you know the deal. And I said I disagree. I think it's going to be an eventful week with a lot of twists and turns. And boy, was it an interesting week or what. A lot of things happened with more consequences to come. So without further ado, let's dive right into it. We begin with the wall of worry. And a reminder of the items in the wall of worry, we have the policy risk from the lovely place in DC. We also have the election risk, the geopolitical risk, China risk, and of course, what if rate cuts don't happen? Or they happen for the wrong reasons. And this week, one of these risks flared up in a big way, and that is the political/election risk. We've been following, or let's just be honest, we haven't been following, but it's been all over the mainstream media. So you had to hear about it one way or the other. The so-called hush money trial for former President Donald Trump. Of course, nobody was paying attention really in real life, except of course the bubble in CNN, NBC, and the likes. But when the verdict came out, of course it becomes breaking news and it becomes a national headline. And now folks have to pay attention. And the verdict was guilty in all counts. And now we have to think about the consequences about the elections. How will this verdict sway the elections one way or the other? And how would this sway one way or the other impact the economy and the stock market? Now, I talked in details, frankly, my opinion, at the risk of alienating a lot of you in the last video about all of this, and I told you exactly what I think, my 2 cents, take it or leave it. And folks, we are a divided nation. And when you look at the reactions to this verdict, you have one side who says, long overdue, well-deserved, finally justice served, the president is not above the law, and this is a great achievement by the justice system in this country. The other side says, sure, maybe the guy's guilty of whatever charges you're bringing up, hush money, whatever that is. But why now? Why do it before the elections? Why is it happening after a series of attempts to take this man down politically, from the impeachments to the other trials to the judgments against him for hundreds of millions of dollars, something we've never heard of before? Outrageous amounts of settlements. And now we have this right before the elections. And this camp believes that it is a manipulation attempt by the judicial system, weaponizing the judicial system to sway the elections one way or the other. And we can debate all day, all night long. It wouldn't matter. Either you're in Camp A or Camp B and you've made up your mind and that's that. The problem that I see in our society is this growing sentiment of if I disagree with something, I have to cancel it. I feel threatened by any opposite opinion to what I believe, which is absolutely bizarre. Take, for example, when I speak my mind, you get the wuss part of the audience. Unsubscribe, Maverick. Cancel. But don't let the door hit you on the way out. F*** off already. I want soldiers with me. I don't want the wuss. I don't want the crybabies. Take, for example, Bobby De Niro, my favorite actor. I worship this guy, but he made a jackass out of himself during this trial.
We step to the side right here. Step to the side.
You're not going to intimidate. That's what Trump does, to try to intimidate. We have to fight back. We're trying to do it. We're trying to be gentlemen in this world, the Democrats. You are gangsters. You are gangsters.
Now, would I ask to cancel Bobby De Niro or boycott his movies, or I'm not going to watch his movies again? Hell no. I'm still going to watch his movies. I just have a political disagreement with him. That's all. By the way, since Bobby De Niro wants to talk about Donald Trump paying porn stars and all of that, you got to be careful because none of us have a spotless past. Let's just put it that way. And Bobby De Niro was one of those guys. Some of us know things about him that if it comes out public, let's just say the guy would be in big trouble. Enough said. But folks, the interesting thing about this verdict that just came out this week, when folks hear guilty, they think about a crime that's been committed. It's an egregious crime, and they cannot vote for a convict, or somebody who's guilty. But then if you ask folks, do you know what he's guilty of, what he just got convicted of? Most folks wouldn't know. Then he explained he banged a porn star, the guy was married, running for president, and he tried to hide it. He made payments under the table to keep it quiet, and he got caught. And then he lied about it. None of us, of course, would do that, right? None of us would do that if you got caught banging a porn star while being married and you're about to run for president. None of us would do that because we're all clean. We're spotless. And if you explain this to folks, well, most people who don't have a predetermined bias about the man would say, well, why would I care? I don't give a shit who the president bangs, whether he catches BJs under the table while in the Oval Office or gives BJs under the table. What do I care? Happy Pride Month, by the way. So long as the guy does the job properly, doesn't get us into wars, and places the prosperity of the American people above everything, then that's all I care about. So I think right now, a lot of folks are making assumptions that, oh, now he's going to win the elections. Oh, now he's going to lose the elections. Most of those folks are talking heads on social media, on X, or Twitter, or whatever the hell it is. And they're talking from predetermined bias. The folks who are against the guy will be more determined now to be against him because he's guilty. The folks who've been supporting him will be more determined now to support him even more because they see that the guilty verdict is a sham. You look at the reception that he got recently over the weekend in the UFC. Applause all over the place. Support, that's his base. But what matters, folks, is what do independents think about all of this? And luckily for you, we just got a new poll. So let's go over it and see what it says. The poll done by CBS YouGov. And the question is, did Donald Trump get a fair trial? 56% say yes. 44% say unfair. Now you break it down to the political lines. Democrats, 96% fair trial. Republicans, 86% unfair trial. Independents, 54% fair trial. So again, it seems that the consensus opinion here, what really matters is he got a fair trial. Okay, what else? The conviction. Did the jury reach the right verdict or the wrong verdict? 57% say the right verdict. 43% say the wrong verdict. You break it down among the political lines, 96% of Democrats say the right verdict, 82% of Republicans say wrong verdict. So it feels that the Democrats are more passionate about this than the Republicans. Independents say what really matters here, 56% say the right verdict. Now when it comes to the question of Trump fit to be president now that he's convicted, 51% say no. And that matters, folks. So before you talk to me about, oh, this is going to make him stronger, he's going to win more now, be careful. This is not a coincidence. If you're upset about this being election intervention, well, maybe it is, because it's going to sway the election in favor of Biden, not Trump. And this is what the poll says. Now, the silver lining is, so we don't go crazy in this country, should Trump serve prison time for his conviction? The majority, 45%, say no, he should not. 38% say yes, he should. 17% not sure. So folks, in a nutshell, if the elections were held right now, today, I think Biden would win. Easy. A lot of folks would not vote for a convicted felon just because, even though What is the crime? Why now? All of these are valid questions, but I'm just being real with you. And the other thing is the economy is getting weaker, lots of concerns, but we're not at a desperate place yet. What am I trying to get to here? What matters at the end of the day, forget about the verdict. We're going to forget about that 2 months from now. What matters is we go back to inflation, stupid. Not the economy, not just the economy, but inflation, stupid. And if inflation doesn't improve by November, by improve, I don't mean, inflation is now going up only by 0.2% a month. No. We need to see disinflation. We need to see contraction in pricing. That's the only thing that would make voters feel better. And we're running out of time to achieve that. As time passes, it seems that it's getting worse because inflation is staying sticky while the consumer is getting weaker. Combination of both, we have a stagflationary process going on in the economy. And I think in time, if the dynamics stay as it is, the economy will get weaker. Folks will feel the gap between their power and inflation, purchasing power that is, and inflation, getting wider. And that will be against Biden. So I think time is in favor of Trump. But if the elections were held right now, I think Biden wins. So folks, we have an interesting few months here coming. Buckle up your seat belts. I mean, you hear this headline, John Legend, famous politician, no, he's not, claims black voters leaving Biden because of masculinity. Disinformation on economy. That's what's going to matter. Of course, they say disinformation about the economy. No, you can't do disinformation about the economy. The economy is what folks feel in real life. And in the last video in this program, we explained to you in details why we see this divorce, where the talking heads, the propagandists in the media, they say that the economy is fine, doing it better than ever before. Inflation is going down. Everything is doing pretty good. But then the consumer in real life is not feeling that way. We explained to you in details why is that happening. And it's not because of disinformation. It is because of reality. And if this reality doesn't improve, between now and November, it's going to be a problem. It's going to be in favor of Trump. So now that we know the trial and the verdict doesn't really matter in the grand scheme of things, and what really matters is the economy and the state of the consumer, let's talk about it. This Friday, we got the Fed's favorite inflation gauge, the PCE report, and it is the Fed's favorite inflation gauge because it is easier to manipulate. And if you can't manipulate the data, you can manipulate math. For example, the month-on-month increase in core PCE, that is excluding the not-so-important gasoline and housing costs, core PCE was up 0.249 basis points month-on-month. How was the number reported by the cooks? They reported the number as 0.2% meeting expectations. They rounded the whole thing down, not 0.25. They took it down to 0.2. But folks, the devil is always in the details. When you look at all of these inflation measures, you want to round it down, you want to manipulate the data, sure, go ahead. But you cannot really mask the true picture of what's going on. You got the PCE month-on-month up 0.3%, the core PCE up 0.2%, wink, wink. The PCE year-on-year up 2.7%, the core PCE year-on-year is up 2.8%. Now, notice that all of these numbers are positive, meaning it's going higher. Inflation is going higher. Price is going higher. Year on year, month on month. The consumer is not going to be happy with that. That's not good enough for the consumer. We need to see reduction in the inflation rate, meaning it goes negative month on month. Just like consumer spending month on month, which went negative. Expectations up 0.1%. In reality, down 0.1%. So when Fed Chair Jerome Powell, Zombie Powell, says, I don't see the stagger or the inflation, what do you call this? Inflation higher, real consumer spending down. I think we see the stag and we see the inflation. If you don't see it, we'll do more. We also got the Chicago Business Barometer, which absolutely collapsed, now reaching the pandemic levels. Not just recession levels, but depression levels. Not a good outlook for the economy here. When we look at real disposable income, it's been trending down. All of the stimmies, all of the pumping, that's fading away now. All what we got from the stimmies is inflation, but disposable income in the hand of the consumer, that's fading away. Okay, when disposable income is going down, what do? You swipe those credit cards up and down, up and down, up and down. When you do that, what happens? You incur debt. As the Fed raised rates significantly from 0 to whatever it is right now, your credit card company's charging more on that debt, meaning the chance of you getting delinquent is increasing. So we see delinquency rates 30 days or more, 90 days plus, now moving higher, aiming for the recession levels that we got back in 2009, 2010. We also got GDP. GDP is trending down. Most importantly, when you look at real personal spending Q&Q, that's also trending down. So the cumulative evidence here, folks, after years of inflation, and inflation remains sticky, combined with higher rates, the consumer is getting weaker and weaker and weaker. And recently, the drop in the strength of the consumer has been more felt than any other throughout the last, let's say, 2 years or so. It seems that, as this headline suggests from Bloomberg, key engines of the U.S. consumer spending are losing steam all at once. And this is not good news for the economy. Not good news if you're running for re-elections. You can manipulate the data all you want, but the consumer is not going to feel good in the ground. When we look at the PCE report, this is the screenshot that I got from the paper. And I want to highlight for you this because we've been talking about it for a while. Because consumer weakness right now, while we still got jobs, we still have access to credit cards, this dynamic could actually open opportunities for investors. We'll take it one step at a time. When you look at the components of the PCE, you'll notice that gasoline, energy goods were up 2.5%. That's obviously going to go down because energy costs went down in the month of May. Commodities prices went down. Who knows what they're going to do in the summer, but for now they're down. What went higher is clothing and footwear. And we've been talking about this for a while now. Report after report after report, pointing out that apparel pricing is going higher. Now, we can't really walk naked. Some of you wish, but for visual perspective, not a good idea, considering the waist size of most Americans. Maybe if Ozempic becomes cheaper, we'll be okay with walking naked all over the place, but not right now. So we have to buy clothes, and it's getting more and more expensive by the day. And as the consumer disposable and spending power is reduced, what is happening to, let's say, expensive apparel stores? Think Lululemon, for example. This is a weekly chart of the name, and you can see that the chart has been absolutely collapsing. It lost almost 40% of its value since the top. If you look at another retailer such as Nordstrom, that's been going down big. It lost almost half of its value. On the other hand, you look at discount retailers such as Ross stores, this stock been doing pretty good. You look at TJ Maxx, all-time highs. The ticker TGX, another discount retailer. You look at Gap stores, we talked about it in this channel, and we suggested that it's going to be a candidate for a short squeeze once the earnings report come out. And indeed, we got a massive squeeze. The stock is now trading at the highs. Another discount retailer. We see the consumer behavior. Since they still got jobs, still got access to credit cards, they're going to spend. They're not going to spend until they lose their jobs. But they're adjusting the behavior of spending. If I cannot afford Lululemon or Nordstrom, Macy's, I'm going to downgrade to TJ Maxx, to Ross, whatever stores I perceive as cheaper and offering me a better deal in this economy. This kind of behavior is not just observed in the apparel sector of the economy, but now we're seeing it in the grocery store. Now we're seeing it in consumer brands. When you go to the grocery store and you want to buy milk or cereal or bread and you buy the national brand, you're paying a premium for that. A lot of consumers saying, you know what, I'm looking for a bargain, so I'm going to go with the store brand. It's the same product. Maybe lesser quality, at least in perception, but it is cheaper and I got to do what I got to do right now. So you see the year-on-year unit sales for store brands increasing over national brands. In dish care, 15.9% year-on-year. Home air fresheners, up 12.9%. If you look at wraps, tortilla shells, up 12.3%. You look at pasta, dry rice, 7.9%. And the list goes on and on. You can see it for yourself here. Consumers are looking for a bargain. When you look at the unit sales, here it is in summary. Store brands versus national brands. We have declines in both when it comes to health and beauty care, so you got to be careful. I know that stocks like Ulta Beauty, Elf Beauty moved higher recently based on a short squeeze, but they might head down again because sales of health and beauty care is going down dramatically. Frozen goods are going down dramatically. Baby care is going down. You got meats. Nobody can afford to eat meat anymore. So we see that whether it is a store brand or national brand, sales are going down. When we look at general merchandise, deli, pet care, produce, bakery, dairy, grocery, household care, store brands, sales year on year going higher. National brands going down. That's the consumer behavior looking for bargains. When you look at discount grocery stores like Aldi, German retailer, the foot traffic year on year is skyrocketing because folks are now looking for bargains. Dollar General, that's also moving higher. Trader Joe's, what's going down though? Albertsons, Walmart, although this data can be deceiving because according to the report from Walmart that we got recently, maybe their core consumers, some of them are moving down to Dollar General or Aldi. But then we have upper middle class folks downgrading and moving to Walmart. And all in all, the volume of sales is going higher. But this is foot traffic. Just to give you an idea, the consumer is looking for bargains. The consumer is getting squeezed budget-wise. And at some point, they're going to get desperate. If they lose their jobs, this country will be in a disaster. Because you got to remember that a lot of these consumers incurred a high level of debt that they cannot really pay for. And with higher rates, they'll fall further behind. So we're just one step away from an economic disaster, and that is the increase in the unemployment rate. And the anecdotal evidence that I get from you guys, a lot of you are real estate agents, you work in the auto industry, you work in liquor retail, you work in industrial businesses and trucking businesses, a lot of you own Airbnbs, and I hear the anecdotal evidence that activities are going down, that you're seeing more and more layoffs in the industry you're working for. And that's a bad sign for the economy. Folks, when the rug is finally pulled from underneath the economy, it's going to happen rapidly. It will happen so fast, you wouldn't be able to wrap your head around it. Keep that in mind, because right now, folks have the false sense of security. But when it happens, you'll look around, you wouldn't even recognize what's going on. Next thing you know, you lost your job. Next thing you know, your car is getting repoed. Next thing you know, your home is getting foreclosed. Next thing you know, you look at your 401k that you're jerking off to right now, and it's down 40-50%. In any case, when we look at this behavior by the consumer shifting from national brands to store brands, that's good for companies like Kroger. You look at the monthly chart of this name, trading almost at all-time high. You look at Walmart, WMT, that's also trading at almost all-time highs. If you look at Treehouse Foods, the ticker THS, this is the company that makes the store brands for Kroger and many other retailers. That stack is down, not doing pretty good, but it could be an opportunity as we see consumer behavior shifting to seek store brands. For now, if we look at the chart, we see, at least was, a declining trend of lower highs and lower lows. Is it changing though? Are we about to see a trend of higher highs and higher lows? This is what we're waiting to see. And if we begin to see signs of that, it could be an opportunity in this stock. Look at other expensive retailers like Sprouts, which been on fire, but probably we have the top right now. It's going to begin to decline. We have a bearish engulfing candle. The stock has its own dynamics of a short squeeze and all of that. But you're not going to be able to shop at Sprouts anymore. You're not going to justify what you pay in Sprouts when you can find the same exact item at a cheaper price in another store. This is at least my experience. We see other indicators in the economy pointing out to consumer weakness. For example, what's going on with concerts? So we know what happened last year with the Taylor Swift tour, paying $7,000 a pop, $13,000 a pop. Well, folks exhausted their budget to go to concerts. That's done already. And now there's nothing left for the rest of the performers. Taylor Swift ate them all, and the consumer is now much weaker than last year. So we see a lot of cancellations. We see a lot of performers now downgrading to smaller venues. Forget about stadiums. Now we're going to book a smaller room because we're not getting a lot of ticket sales. Even J-Lo, who's supposed to have a residency here in the city of Las Vegas, she canceled her summer tour. And rumor has it that they're going to drop her. She's not going to do a residency here because ticket sales are not good, and now folks are realizing that J-Lo is a major asshole. I think Ben Affleck dodged a major bullet here. But the point being is the consumer is getting weaker. They cannot spend on this garbage anymore. And we can go on and on about what's going on in the airlines industry, what's going on in Airbnbs, what's going on in booking trips as the consumer keeps getting squeezed day by day. So again, in summary, and we can expand on this in a longer video, folks, but this dynamic is not good for store brands like Procter & Gamble, General Mills, Kellogg's, Kraft Heinz. Certainly not good for Live Nation as we see spending on concerts going down. Not good for expensive apparel stores like Lululemon and Nordstrom, but it could be good for Kroger, store brands, Treehouse, Walmart, Dollar General, and cheaper clothing stores like Gap, TJ Maxx, and Ross. Now you have to be careful. This is not a suggestion that you should short a stock or buy it. Because you can look at this as a suggestion to short Lululemon, for example, but the stock is already down 50%. So we actually have a call bet on it that's going to rebound in this channel. But again, you can dig into the details of all of these companies and the earnings that we got recently. You can find maybe it is worth it to hold TJ Maxx for a little longer. Maybe it is worth it to ride the momentum of Walmart. Maybe we'll see weaker sales for Procter & Gamble. I'll take a short on that and leave these decisions for you because they require more analysis. We have to dig into the fundamentals of these companies, and then we have to compare that with the stock performances. Folks, with all of what I just talked about right now, consumer weakness and sticky inflation, we have some Fed zombies who are now acknowledging that the Fed policy right now is not restraining enough. And the dynamic that we have as is not ideal because it is weakening the poor, the middle class, even the upper middle class to a certain degree. But it's not taming down corporate spending. It's not taming down private venture capital spending. It is not taming down the consumption by the affluent consumer. And now they're debating what to do next, because they know if they cut rates right now, commodities prices will go higher. And whatever left of the inflation dynamic right now will only get stronger. On the other hand, if you raise rates, you're going to damage what's already been damaged even more. And there is no guarantee that it's going to damage corporate spending from Microsoft or to NVIDIA or the affluent consumer who's going to cruises and still shopping in the economy. It's not a good position to be in, folks. But of course, we have the propagandists in the Fed, in denial, delusional, headed by Powell, of course. But even New York Fed President John Williams, he came out this week and says that, yeah, I still see 2% inflation in 25. And oh, by the way, it's going to happen by a soft landing. Everything will be fine. Tell me how we get to 2% inflation without more damage in the economy. He can't explain that. But of course, don't rely on your beloved so-called journalists in the propaganda media to ask these questions. When they get Williams, they only ask the softball questions. What the oligarchy wants to hear, what the hedge funds want to hear, what the algorithms of the stock market want to hear. But they wouldn't ask anything that would cause these zombies to acknowledge the reality. Now, lucky for them, the stock market bubble that we have right now been keeping the economy from falling apart. The question is this bubble sustainable? I think we all know the answer, and the answer is no. The main question becomes when? When does it pop? Well, this week we got some signs that it's beginning to pop. We're seeing some major weakness in leading AI names. Take, for example, Salesforce. After reporting earnings, the stock went down by 20%, the worst drop since 2004. Here's the most important commentary. Analysts said that broader macroeconomic challenges returned with a vengeance during Salesforce's first quarter. So now we see a little bit of weakness beginning to show up in the B2B spending, in the software segment. And a lot of these software companies will fall apart because they cannot afford to have the same spending power as Microsoft or Alphabet or Amazon, meaning that these big giants will eat their lunch. The next step is not cloud or how many subscribers or members you have. The next step is, what do you got when it comes to AI? And if you have Microsoft can replicate your platform, only do it better, and overspend you, then what are you good for? We see a lot of software names getting absolutely creamed as of late. We talked about Salesforce in details in a video titled Ohana, or of course bullshitter CEO Mark Benioff, who claims that he has Ohana, he loves everybody and the employees come before everything. But of course he laid them off to pump the stock higher. And since then he's been dumping $4 million worth of shares every single day. The oligarchy, the insiders are cashing out. You, the retail investors, are buying the hype and buying the dream. You look at the chart of CRM, Salesforce, weekly chart, we got the topping head and shoulder, and we got a massive flush down. Matter of fact, it's down over 25% from the top. It was down even more before the rebound on Friday. But if we clean up the chart all in all, the stock has been flat since August 2020. And now it has a dreadful look, by the way. I mean, when we got the pop higher, we had a pretty good look, the inverse head and shoulder. Now it appears that we have a double top. But all in all of this roller coaster ride for what? For a flat stock? For almost 4 years now? What is the point? Now, when it comes to hardware, we also got bad news for AI because Dell reported earnings and the stock went down by almost 20%. Why? Because AI servers are sold at near zero margins. The sequential growth in sales for Dell went negative this quarter. But of course, the folks at Barron's, they say that some see opportunity in Dell's bad news. Oh, I'm sorry. This headline is from October 19th, 1999. I wonder what happened after that. Why do I bring the 1999 example again? It is eerily similar, almost identical to what's happening today. The stock of Dell, by the way, was one of the biggest stocks during the dot-com bubble. It exploded higher, as you've seen today, in this AI mania bubble episode. And then it came down crashing to the point where it was delisted. And there was an important warning sign that the dot-com is about to pop way before the crash happened in 2000. And that comes from the stock Compaq. Some of you remember, old-timers, you remember these days. And you remember the story of Compaq. There's a stock today, which is the Compaq of the AI mania. That stock is also showing the same exact warning signs from Compaq in the 1990s. I'm not going to talk about it in this video. I'm not going to waste my time because I know that the response by most of you would be, but Maverick stocks go up, nobody cares. I think you should wait to to see it to believe it. And when fear begins to brew, then I'll remind you of it. And I'll show you the comparison. And you'll be amazed. But when it comes to this AI mania, even the Wall Street Journal now says that the AI revolution is already losing steam. The pace of innovation in AI is slowing, number one. Its usefulness is limited, number two. And the cost of running it remains exuberant, number three. And I say bingo. It's beginning to frizzle out. And we're beginning to realize that this whole AI bullshit, it's overhyped because AI been with us for decades in many forms or another. In the year 23, they put a spin on it by saying, oh, it's generative AI. Well, generative AI is dumb as rocks because if you ask Google AI tools, it'll suggest that you should eat rocks and glue pizzas. If you use these AI tools to cheat in your exam, chances you'll get an F anyways because it'll spit out the wrong answer. And this is what we pumped $3 trillion plus worth of valuation, worth of a bubble in the United States stock market, and billions more in global markets. So AI can tell us to eat rocks, glue pizzas. I think the narrative is now crumbling. But there is one name that is still performing, that is still holding, that's still brought up as a counter to anybody who tries to poke on this AI mania. And that name is NVIDIA. And for now, it is still holding, but it's going to face its day the same way. Go back to the 1999 episode, study how it worked out. It's going to work out the same way. So where does that leave us, folks, when it comes to the market? Remember the wall of hope? We said that the market is going higher because of two things. The hope of rate cuts, lower rates, and the AI optimism. If you have both active, meaning bond yields going down, for the good reasons that the Fed is going to cut, and you have the AI optimism going on, you see insane market surges. When you have one working out but not the other, if it is the AI mania working out but rate cuts not so much, we see the market floating higher because the AI mania has bigger weighted names. Microsoft, NVIDIA, chip names, Amazon, Apple, Meta, Google, so they lift the market higher. But then when you have weeks where we see the AI mania getting damaged, such as this week, but then we see rate cut optimism moving higher because of a weaker PCE or a weaker CPI or whatever. We see better breadth in the market, so we see participation by healthcare, by utilities, by real estate, by banks, by some of the consumer cyclicals. And then we see the bigger names going down. And all in all, the market might stay flattish, go down a little bit, but certainly the AI mania being active is a lot better than rate cut hopes being active. This week, we've seen the flip-flopping in both. In the beginning of the week, rates were going higher. So we've seen those equal weighted S&P, if you look at the RSP, which is the ticker for equal weighted S&P, utilities, healthcare, industrials, cyclicals, metals, they were going down in the beginning of the week. But the AI mania based on NVIDIA's earnings was still alive. So the market was going higher, led by the heavy weighted names. Then came Salesforce, then came DELL. We've seen the AI mania damaged, and the market went down. Then comes the PCE report and revives rate cut optimism. And we see bond yields going down, and the dynamic was shifted. The big caps went down, but other stocks in the market performed. And we'll see this yo-yoing back and forth until both of them is dead. In the meantime, this dynamic is causing one of the worst market breadths that we've ever seen. The S&P 500 relative to the equal weight index, that's the RSP, that we just talked about. The performance is the worst since 2009. In plain English, what does that mean? It means that the stock market is going higher based on a handful of names. And this handful, which it was more than that before, was the Magnificent Seven. Then we went down to the Magnificent Five, and now probably the Magnificent One in NVIDIA. That's what's keeping the stock market higher. Otherwise, this market will be crashing right now. And you look at the earnings yield versus the 10-year yield, meaning is it worth it to be in the stock market or not? What is the risk premium? The risk premium is absolutely horrific. It says that there is no point of being in the market right now. You're delusional if you're staying in the market. You're better off getting the risk-free return. I know what the counter is going to be, but look at the stock market. Look at the indices, Maverick, the Qs, the SPX have been going higher. Yes, they've been going higher because of the large cap names. How long do you think that these large cap names will continue to perform before they face the fate of Salesforce and DELL and many other names that we've seen this week and before? And then what? Then the market will flush down in a big way really fast. You don't want to be in the market when that happens. So either you're a great timer or you need to begin doing some de-risking strategies. Where is the opportunity for de-risking? The obvious answer is the risk-free rate in bonds and fixed income and money market funds. But there is another surge that's about to happen. If you recall back in the dot-com crash, the tech names went down big. But after they crashed, we've seen a new regime being born. Housing, banking stocks, construction stocks began to rise and take the leadership of the market, while the tech stocks been dormant, doing nothing at all, until these names, banks, housing, construction, got in their own bubbles. They crashed and then tech came back in the 20 teens because of low rates. This chart shows you exactly what happened here, the NASDAQ versus commodities. And the outperformance of the NASDAQ, the AI mainly, the chips, the technology names, versus commodities is at the peak of the dot-com bubble, meaning as the dot-com bubble goes down, we will see the rise of commodities, which means not a good outlook for the future, folks. It means that inflation will be stickier and will be with us for a long time as commodities outperform. How would that happen? We just talked about the consumer weakness. That's going to get worse. And at some point, the Federal Reserve is going to respond that, okay, we're seeing enough weakness now. Stocks went down 10, 20%. Time to interfere. Time to cut rates. As they cut rates to save the economy and the market, they're going to devalue the dollar. And as they devalue the dollar, commodities will come back. And that's going to be the next trade. That's going to be the next bubble. It ain't going to be good. If you have a bubble in commodities, not going to be a good future here, folks. All I got to say is buckle up. Now, the last thing I want to cover before we segue to the market information is what happened in the last, let's say, hour in trading during Friday, because this is the 10-minute charts of the SPX, the cash index of the S&P 500. You can see that in the last 20 minutes, we've seen a big pump. And a lot of folks, we joked about it, of course. We said the plunge protection team is in and all of that. But what actually happened? We can speculate. You can talk about, trading was frozen in the middle of the week, and now Friday, by the end, we get a mysterious pump. I guess the plunge protection team been active this week to prevent a flush. Look, I love the entertaining factor of the conspiracy theories, and maybe they're right. Maybe that's what actually happened. But I think there is a more reasonable explanation to all of this, which is the end of the month and, of course, options market activities, what the market maker decided to do. So if we look at the expiration date of May 31st, Friday, and we look at the SPY, the S&P 500 puts, betting to the downside, we have seen huge open interest at the 520 number. And at some point on Friday, we were almost at 520. That would have placed the market maker at jeopardy, that they have to pay, they're obligated to pay those 520 puts, and everything above will be exercised and it will cost the market maker. At the same time, look at the OI change. Anything above 524 was closed. What matters to the market maker is the open interest, the highest open interest. That was from 520, let's say, you can go back to 518 if you want, but it's really 520 all the way to 525. The market maker would love to push the tape above 525 to neutralize most of those. So they have no obligation and exercise, which will mean they have to buy the SPY at a loss at these strike prices that you see. On the other hand, when you look at the calls, look at the OI change. You don't see closing, you see adding. Folks adding to these calls, betting that the market will go higher. And I think what the market maker did in the beginning of the day is drop the tape down to neutralize a lot of these upside bets, scare them away so they can eat the loss and get out of the picture. And then by the end of the day, as we've seen more and more folks piling in, buying these puts, betting that the market is going to go down because we got a CPI that is favorable, but the stock market faded it, went down to the lows. So we're going to crash next week, and folks begin buying puts. The market maker said, okay, watch this. I killed the call options buyers, now I'm going to kill the puts. And they pushed the tape higher. At the end, the market maker wins. That's what I think it happened on Friday, and it doesn't mean that we'll see a follow-up on Monday or anything like that. I think it's the end of the month dynamics and the market maker exercising maximum pain on both the calls and the puts. Beginning of the day, took care of the calls who were betting that the market is going to rebound because of the PCE report. At the end of the day, they took care of the puts who were betting that the market is going to flush down now that it faded the PCE report. But we warned in Discord, folks, if you've been following us, that the market is getting really, really oversold in the hourly time frame. So you have to be careful that we might see a rebound. We got a rebound, not Monday, not next week, but on Friday in a big way. But again, in summary, I think it's the market maker exercising max pain. But the conspiracy theories, entertaining as hell. With that, folks, let's add more color and cover the market activities, beginning with the closing of the indices last Friday. And here we go. The diamonds in the green by 574.84 points, or a gain of 1.51%. The Nasdaq in the red beat flattish, down by 2.06 points, or a loss of 0.01%. The Spider in the green by 42.03 points, or a gain of 0.80%. While the Russell 2000 small caps up by 1.72 points, or a gain of 0.84%. All the indices were down at the beginning of the day, exception the Dow Jones got way oversold. so it was due for a rebound, but the rest were down until the last-minute pump, I believe, by the market maker. We look at these sectors. On top, energy. Then you got real estate, utilities. Those are benefiting from yields going down. Technology at the bottom. That's because we got weakness from DELL and the AI mania. If you look at the week all in all, not different than the daily performances. We've seen energy at number 1, followed by utilities, real estate. That's your stagflation dynamic. Energy, deflation, utilities, that's the stag. Real estate, more sensitive to yields. If yields go down, it goes higher. If yields go up, it goes down. But technology, the risk on, at the bottom. So we've seen some damage in the AI mania. Will it be enough, though, to hurt NVIDIA? I don't think we're there yet, but we're going to get there at some point. We'll look at the breadth. The NYSE, pretty good, 76% advancing versus 23% declining. The NASDAQ, 55% advancing versus 41% declining. So there was a neutralization effort by the market maker to close the NASDAQ as close as they can to 50-50. I think that's why we got the roller coaster ride on Friday's session. You look at Friday's heat map, everything doing okay. Banks doing okay, cyclicals okay, industrials okay, energy, utilities, real estate, healthcare, even the staples doing okay, but the big caps, the Amazons, the Nvidias, the Microsofts, Apples, Google, Meta, all lagging because we see some damage in the AI mania. So Friday's session, at least in the beginning, all the way to the last 20 minutes. If we go back to the wall of hope, the AI narrative was not active, but the rate cuts narrative was. And this is why we see the RSP, the equal weight, the rest of the market doing okay, not the big caps though. If we contrast this with the weekly heat map, we see a mixed picture. So when we look at the AI mania, lots of damage in the chips, in software, in the cybersecurity names. Even Microsoft was down almost 3% for the week. But then you got Nvidia and Apple outperforming. So some damage in AI, but the king of AI, Nvidia, was still in the green, was still pushing higher for the week all in all. Then you look at the rest of the market, mixed picture, weakness in healthcare, weakness in banks and cyclicals, but energy outperformed big for the week. So when you look at the weekly picture all in all, it tells a story that Tuesday, Wednesday, it was all AI. Then comes Thursday, Friday, the rest of the market began to pick up and AI went down. And this is what you get as a final result. If we look at the heat map for the ETFs, you can see that all in all, the market is slightly positive, but flattish. But we cannot really extract one theme or the other because, believe it or not, bond yields, they went up, then they went down. The dollar went up a little bit, then went down. So all in all, it was a neutral move by the indicators. But the relative reactions to say dollar-sensitive names was mixed. So you have GDX gold miners up, but then you have Chinese equities down. If you look at yield-sensitive ETFs, when yields go down, you see utilities doing pretty good. So the XLU continues to go higher. That is the defensive yield-sensitive. But then you have the XBI, more of the risk-on yield-sensitive. That was negative for the week. So all in all, it's a mixed picture. You cannot really extract the theme. We have to wait and see what happens next week as the market begins to settle in. We look at commodities on Friday, down across the board for the most part, led by softs. So we see drops in cotton. OJ finally down about 4%. Coffee also down about 5.25%. But understand that OJ and coffee been on fire. So down 4 or 5%, that's just a dent in the major rally we've seen so far. We're beginning to see that cocoa rebounded, find some ground. Whether it heads to the highs or not remains to be seen. I think that the weakness in metals will continue with us. Gold, silver, although platinum was in the green on Friday, copper, palladium down. I think the dollar is not ready to go down in a big way yet. We have macro data coming out this week. And I think that the problem with metals, at least for now, if you see economic weakness, yes, the dollar goes down, but that's not good for metals. Maybe good for the defensive metals like gold and silver. Now, if we see bad news, good news, from the employment data as an example, then the dollar might go down and push those metals prices higher. But for now, I think we'll see de-risking until we get that data out of the way. Then the dynamic in energy, you see crude oil down, be it the WTI or Brent, although we'll see what happens with the OPEC Plus meeting that took place over the weekend and the reaction after that. But the interesting phenomenon is RBOB is up while we see crude down. And this kind of dynamic is good for the refiners. So Friday's session was good for refiner names like Valero and Marathon Petroleum. If we look at the week all in all, we see cocoa and oats on top, but we see damage here in OJ, natural gas, palladium, even though most of these names been on a tear. So these are just pullbacks in the recent rally. We move on to the big casino options. What do we see here? Nvidia, Tesla, the most active names on Friday. The rest, the volume is down, although Apple is beginning to heat up a little bit. We see more buying of puts showing up, but not enough. to say that we are in fear or anywhere near to fear. We see Johnny come latelys coming out buying puts, and the market maker, of course, smacked them right in the face by the pump on Friday. If they're neutralized, then I think the market maker has the room to push us back down. If we look at Friday's bullish flows led by Amazon, DELL, DJT, Donald Trump, VST, CRM, Salesforce. The bearish flows led by BITO, this is the Bitcoin ETF, SPX, the cash S&P index, NEE, Next Era, and Lockheed Martin. But of course, we always look for the details and the interesting trades, unusual activities. And we have one here for Amazon. It is a long synthetic future. What does that mean? Somebody's selling a put and buying a call. And in this case, they sold the 165 puts to finance the 165 calls. The expiration date of June 19th, spending about $8 million. So this is a major bullish bet that we will see Amazon moving higher from this point here. Now, we had a bearish trade on Amazon in the beginning of the week, and we closed it at a profit on Friday because it got really oversold. I'll show you that in a minute, but we bought it for $1.80 a piece. We closed for $2.70 a piece. Now, a lot of you closed at 3.20, so you made more profits than me because Amazon went down big after that. But there was a threshold for you to close the trade. You had to close once the gap was filled. Here's the chart, the hourly chart for Amazon. Once we went down to 173.82, you filled the gap, the RSI is way oversold, the MACD is way oversold, and then we've seen a rebound in the last hour of the day. And a lot of you also switched to calls, which at least for now appears to be the correct call. And this trade that we just covered, $8 million at the 165 line, indicating that at least Amazon will be above 177, 178 by the expiration date. At least if it gets there, the trade will be closed at a profit. Now, another interesting trade that we got for the SPX, it's a long put, 55 puts, expiration date June 20th. So not a lot of time before expiration. Somebody was betting that the SPX will go down further from here. And they bet about $78 million on that. We'll see what happens, but this is a major bet. And it goes hand in hand with the next one here, the SPX short call. Somebody sold the 4,000 calls for September 20th this year, cashing in a premium of about $300 million. So we see major bets that the S&P 500 will be trending down in the next few weeks, next few months. And here's a really interesting trade for Meta, a short synthetic future. So it's the opposite of the Amazon trade. Somebody's selling the calls, the 500 calls, the expiration date August 16. To fund the 500 puts with the same expiration date, they paid about over $9 million for those. So betting that Meta will go down. Let's move on and do some charts and then wrap it up here, folks. We begin with the SPY, the S&P 500 hourly chart, of course. All eyes on the last hour pump. What happened? Does it change anything? Well, there was a lot of risk, folks, for a rebound. Because the RSI got way oversold, as I'm pointing out, the MACD got really oversold. Did we anticipate this kind of a pump? Of course not. But I think the options market activities, the expiration date, had a lot to do with it. Does it change anything on the daily chart, though? Well, it takes us above the 20 days moving average, so now that becomes the barometer. If we lose the 20 days moving average in white again, then okay, we're going to go back to the lows and revisit the 50 days moving average in blue. If we maintain the 50 as support, then we have something else going on, and the market might rebound higher. But if you look at the momentum indicators, the MACD, the RSI, the Vortex indicator, all of them are pointing out that we have bearish momentum going on. And rebound or no rebound on Friday, it doesn't change this momentum one iota. Until we see the follow-up on Monday, we cannot say for sure that the rebound is sustainable, the end of a correction or not. For now, your eyes will be glued to the 20 days moving average. Don't eat glue though, AI is stupid, but keep your eyes glued to the 20 days moving average. You lose it, you double down on the puts, you enter new puts, we keep it Monday, Tuesday, then the market is saying, watch out, we're done here. We're probably heading higher. If we look at the hourly chart for the E-mini futures, roller coaster ride. In the morning brief, we talked about 52.50.5. You lose that, we'll make lower lows. We did make lower lows, but then came the pump. Does the pump change anything in the dynamic? Not really. We're still below the bull to bear advantage line, 5,306. We close above, bull's back on track. We trade below again, no harm done. The bears are still in charge. We look at the Q's hourly chart. What do we see here? Lagging, of course, the S&P 500, but notable that we got a pump in the last hour. The RSI was way oversold. So is the MACD. The MACD is still oversold right now, even after the pump. Does it suggest one way or the other that higher we go, lower we go? It doesn't say a lot, but it says that the downside momentum is limited until the MACD is neutralized, until it gets back to zero. Whether by consolidation or more upside, that's up for grabs. You look at the daily chart for the Q's, any damage here? We haven't lost the 20 days moving average, we're still above, but the momentum indicators are pointing out that it is changing from bullish to bearish. In other words, if we close below the 20 days moving average, 449. Then whatever rebound we got in Friday's session doesn't matter. We're going to head down and reach the support of the 50 days moving average in blue at 440. And you look at the Vortex indicator, we're using the 10 period, not the 14 this time around. It's been given us spot-on indicators. So when we see the red line above the blue, bearish momentum is going on, time to short. We see the blue line above the red, we know that, okay, it's time to cover, it's time to go along the market. If we expand the Vortex in this way, when you see clear, decisive crossing one way or the other, those are the juiciest trades. When you see the action going back and forth, that's a battle, that's a chop, not a good period to bet one way or the other. But when you see a clean cross, gaps being opened between the blue and red lines, those are the juiciest trades. Now we have the red line crossing above the blue. It suggests that it is bearish momentum, despite the rebound from Friday. If we continue to see the gap opening up, it's more of the evidence that we should stick with the bearish momentum. If we see the blue line coming back up and the Q's trading above the 20 days moving average again, then we're probably going to head into a chop and we don't have a decisive momentum one way or the other. Look at the NASDAQ futures daily chart. What do we see here? The rising wedge played out. The momentum indicators all pointing out for bearish momentum showing up. Despite the rebound on Friday, we did not recover the bull advantage line at 18,691.25. And if we go down on Monday's session, then you'll know that Friday was a pump based on the market maker activities. And down we go until we go to 18,121.5. If we lose that, then the bears will solidify the advantage. And we will probably see more declines to come in the NASDAQ. If we look at the IWM small caps hourly chart, what do we see here? Within range, believe it or not, 202.53, that's support, 205.59 resistance, even though we closed a tick above. Not decisive enough to say that we're going to go one way or the other. Although, for now, the bias is still to the upside because of the closing above 205.59 and because of the possibility of an inverse head and shoulder pattern. But mind you, on the daily chart, sure, we're above the 50, a tick above the 20 moving average. But we still have a pattern of a topping head and shoulder in the IWM. So you have to be really careful here. On the hourly, you might get a little pump out of it, but on the daily, we still have the risk of a topping head and shoulder. If we look at the dollar, that is still at the risk of a topping head and shoulder. Got a rejection of the 50 days moving average in blue until the dollar trades above the 50. The trajectory now is to the downside. Now the dollar going down, that is supposed to be good for metals, that is supposed to be good for equities, but we're not seeing that reaction yet. We're seeing gold, the old man, actually playing out a bear flag pattern, going down along with the dollar, as if gold is saying, watch out, the dollar is playing possum. It's going to pop higher, and I don't trust it for now. You look at the gold miners, GDX, that is also consolidating in a bear flag pattern below the bull advantage line of 35.74. We lose the 20 days moving average again on Monday. Then we're going to go down to the lower Bollinger Bands at least 33.5. The SLV silver, again, even though the dollar going down, the SLV is going down too because it got too hot, folks. Double top, check mark. The indicators in the MACD shifting from bullish to bearish, check mark, so is the RSI, and soon enough the Vortex indicator. So if you're long gold and silver, you want to continue to hedge. If you want to go long, you got to wait for further clarity. You got to see a decisive move down by the dollar after all of the macro data that we have this week. If we look at UK oil Brent, the line in the sand, the red line is 81. If we close below, you might see more declines to come in energy. So you got to be really careful with your energy holdings. We've seen really good performance this week. Energy stocks going up. But if Brent goes down below 80, if the OPEC Plus pump doesn't work out, then I think energy stocks will also go down. The only thing that could work out is refiners if the gasoline RBOB continues to outperform crude. If we look at the 10-year yield, what do we see here? We can see that we have two green candles, a rebound of the 20 days moving average Tuesday, Wednesday. That's when we've seen what? We've seen the big caps going higher while the rest of the market going down. Then comes Thursday, Friday. We've seen 2 down days in the 10-year yield. That's when the market breadth improved. We've seen the AI mania taking a backseat, but the rest of the market rebounding. Now, the risk here, of course, that we could see a retouch of the 20 days moving average again, but the 10-year rebounds in an ABC pattern. If that is the case, then the rest of the market is not going to be good. They're going to pull back again. Any yield-sensitive stock or ETF will pull back again. If we see that in combination of the AI mania narrative being damaged, such as NVIDIA, the chip names, the software names going down, then the market will flush down again because you have two hopes, the wall of hope, both of them being inactive. Of course, the macro data will determine a lot of these moves, but understanding these dynamics will aid you to making good trades and timing your trades as good as you can. Take, for example, the XHP weekly chart, got a rebound of the 20 weeks moving average, but if yields go higher again, then we're still going to be on track of the inverse ABC pattern. Now, We were not stupid. We used the data from the bond yield at the 10 to our advantage. So earlier in the week, we opened XHB 100 puts, expiration date 21st. We paid about $1 for them. Then before the rebound, we closed them for a profit of about 50 cents. That's a 50% profit. And the same with the IYR, the real estate ETF. We got the 85 puts. We paid about $1 a piece for those. We closed them for $2.35 a piece on May 29th before the rebounds that we've seen Thursday, Friday, when bond yields went down. So you see the big rebound that we got in the IYR, above the 200 days moving average in yellow and above the 20 days moving average in white. But this could be volatile based on bond yields. Bond yields go higher, the IYR will go down again. No doubt about it. Then you have another bond yield sensitive ETF in the KRE regional banks. As yields were going higher, the bid was against the KRE. But then we got way oversold outside the Bollinger Bands. That's when we said, okay, you gotta be careful if you're short. It's time for a rebound. Got a rebound Thursday, Friday, but we're short of the 50 days moving average in blue. We still have risk that if yields go higher, the KRE could form a topping head and shoulder, and down she goes. The XBI Biotech weekly chart. It is now consolidating, waiting to make up its mind. If it closes above the 20 weeks moving average in white, then we got a bullish signal on it. If we lose and close below 87.89 for the week, then we got a bearish confirmation of a topping head and shoulder, and down we go. What would dictate how the XBI behaves? If you said bond yields, you got it right, my friend. If you said what dictates bond yields, the macro data, you got it right again. Then we got the VIX, the volatility index. We got a rejection of the upper Bollinger Bands and the 50 days moving average in blue. And we went down all the way to the 20 days moving average as we anticipated on Thursday's show. Now what happens? Believe it or not, the VIX is still in bullish momentum. We could see an ABC rebound and it makes higher highs, so don't discount that the VIX could go higher. Although, you're not going to go long the VIX until you look at the weekly chart and we see a weekly closing above the 20 weeks, not days, weeks moving average. You see in white right now, sitting at about 14. You close above, that's the point when you go along the VIX. Big Kahuna Apple, what do we see in the daily chart? We're still stuck in a range, 187 support, 192 as resistance. We closed above a tick. Is it decisive? No. If we see a follow-up, sure. Now the bulls got the advantage. But I think that we're losing a lot of momentum. I think that Apple is going to go down, lose the 20 days moving average, and lose 187. And that would be the juicier trade, to trade it down. So right now, I'll be patient with it. I'm not going to chase it if it goes above 192 again. Because if you look at the upper Bollinger Bands or the momentum indicators, the upside is limited, the downside is plentiful. If you look at Tesla, this has been consolidating in a range, and I've been saying, folks, if you're trading Tesla, you're giving the market maker your cash. It is now consolidating, building this energy. It will make a big move one way or the other, but betting on it one way or the other during consolidation is a fool's errand because you're paying too much for the options and you're not seeing a decisive move yet. If we look at the weekly chart for the souffle, we can argue that this is a bull flag pattern and the big move will be to the upside. Warranted, granted, in this case has the upper hand right now. But to counter it, we can argue that this is also a bear flag pattern, and it could play out and flush us down to the lower Bollinger Bands until you see a decisive move one way or the other. A big candle above the 20 weeks moving average would say that the bulls got it. We have a bull flag going on. Now you can bet on Tesla for higher highs to come. But what if we flush down instead? So you have to be careful when we have consolidation and indecision in this case. NVIDIA daily chart, what do we see here? We got down almost to the penny for the pullback target of 1064.75, but we did not close below. If we do close below, I would say that the trade will be closing the gap, at least going down to the 20 days moving average. That would be the 974 puts. You can also take the 1,000 puts and sell a spread at the 975, which we're probably going to do. But you got to see a loss of 1064.75 first. Otherwise, this is still a bullish pattern. And lastly, we'll look at tulips. Bitcoin, what do we see here? Just like Tesla, consolidating, waiting for a big energy release. And right now, without the loss of 67,000, the odds say the pop will be the upside. You lose 67,000, then the odds change for a flush down. But for now, it is just consolidating, eating time away. Let's move on to the conclusion of this video. What do we have on the economic calendar this week? Monday, June 3rd, we have the Flash Manufacturing PMI. It comes along with the ISM Manufacturing. This is a market-moving event. And then we have construction spending data, and this is going to be important for a lot of stocks in the market. Comes Tuesday, June 4th, we have factory orders and job openings. Wednesday, the 5th, we have the ADP employment report. ISM Services comes, of course, with the Flash Services PMI. Definitely a market-moving event. And then we have Thursday, June 6th with the initial jobless claims. But the big kahuna comes Friday, June 7th. We got the big payrolls data. And that's going to be definitely a market-moving event. So buckle up your seatbelts, folks. We have an interesting week ahead. But this is all I got for you for now. I hope you found the show informative and entertaining. And if you did, return the favor by pressing the like button, leaving a nice comment, and subscribing to the channel. If you're interested in more, please help us out by becoming a member here on YouTube, by clicking the join button, or by joining us, better yet, in Patreon. But with that, folks, this is all I got for you for tonight. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
I mean, you do know you're a freak. Your deductive powers are a gift from God or chance or a stray shell of sperm or whatever, or whoever the hell wrote your life script. A gift, not earned. You do not know what I know because you have not earned those powers. You don't know how to assess your competition because you haven't competed. Don't make me your competition.